If you look at this bear market, it's obviously very fast. Lots of people have been talking about the speed of this bear market, the sharpness of the fall, the fastest fall of that size that's been seen for many, many, many decades. But it's also a very big bear market, even though it's quite short in duration. It's 36% from its highs to its lows in America, and that makes it the ninth biggest bear market in the US on record since the start of the S&P 500 in 1928. So 100 years or so of data, the ninth biggest bear market and the quickest one as well. But what I would say, and what's interesting about when you look at the sizes of the bear markets and put it in perspective, is this one, to get bigger, or the bigger examples, if you like, are all very dramatic affairs, and they tend to come with enduring recessions that last many, many quarters or even a couple of years. So, and they tend to be accompanied by banking crisis or major oil shock. Most of them are clustered in the 1930s. One of them prices in the beginning of World War II. One of them is 1929 to 1932, when you have a major banking crisis with several hundred banks going bust in the United States and globally. And of course, you had the Treasury Secretary at the time, Mellon, talking about liquidation. So a very different policy approach. So my point is, you sort of run through the list, and the majority of them come with that enduring economic downturn that lasts for a long period of time, and therefore are very different to what we have today.